Hello and welcome to Options Guide TV. My name is Brian Overby and I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. All right, well, a lot has happened since Monday. We did get bearish on Monday, and that trade paid off almost instantly. And so we're going to start by just looking at the SPX trade, because if you did put the trade on, there are some questions and there's some benefits to doing the S&P 500 index. And some of them, one of the biggest benefits of the index is that it is a cash settled index. So if I ride this trade all the way to expiration, which might actually happen here, they settle in cash, meaning that where there were options, you will end up with cash. Not where there were options, you will end up with stock. That is not the situation, and that creates issues sometimes with option strategies on stocks, especially when they get deep in the money. And I'm actually writing a PowerPoint that I'm going to put together that I'll be presenting on a different platform that is in regards to landmines that you need to look out for on stock options, in particular in this environment where there's zero commissions to exercise option contracts and buy stocks. So just basically zero commissions on stocks, just in general. So in that market environment, early exercise can happen a little bit more often than not, and we would be in we have that issue right now in the S&P 500 index because we're so deep in the money. But another benefit of the S&P 500 index is that they cannot be exercised early, which means that you can ride it all the way to expiration. You don't have to worry about being assigned. And the settlement value based off of Friday's close, especially if you're trading the weeklies in the S&P 500 index, and that actually is highlighted by the symbol, which is SPXW. When you look at the chains, you'll notice that. And that index is that index means that the settlement value will be determined on the Friday of the options expiration on the close. And that will be the only time that people that own option contracts can exercise and assign people that are short option contracts. All right. So some of those benefits are there. Let's start by just looking at the trade. So let's run to the Tradier Pro software. I have it all up and running. Let's send it to the what if calculator. See what happens when we do that. Okay. And we'll pull it back down. We'll zoom in a little bit. Okay. We set up this trade on Monday. Market was up here, up in this range. Well, actually not that far above our strike. And we said that if the market comes down a little bit, which would have been about 1%, a little less, about 0.5%, all the way down to 1%, which is basically the range of the wings in the butterfly, that we're going to be fine. But if it blows us away and it goes all the way down, which it ended up doing, we're still going to be okay, because we did an open wing butterfly, which means that we bought a long put spread, which is that does the lion's share of the work here in our butterfly. That's what would make us profitable if we were correct on our forecast. And then we sold a short put spread, which ends up paying for the long put spread. And that's a butterfly. And it just happens that the middle strike of the butterfly is the one that you sell in the short put spread and the one that you sell in the long put spread. Hence, it's a 1x2x1. Okay. When the short spread is opened and we make it a tighter short spread than the long spread, that allows for profitability if the underlying stock blows through your strikes in your butterfly. And that's what happened here. So we put the trade on Monday, and we paid $2.60 for the trade. The maximum that it can trade for now is the width between the strikes. And basically, we look at the long put spread, which is 56.50, which I'm highlighting on my screen, to 56.30, which is 20 points. And that's one of these short options. And from 56.30 to 56.15, that's 15 points. So the butterfly, if we go below the 56.15 level, should trade for that difference, which is $5. We put the trade on for $2.60. Right now, it's showing that it's trading for around $4.40. So there's still a fairly large amount of time premium in this trade. And if you notice, the market is all over the place in that the midpoint on this trade is jumping like mad. And part of the reason why that is, if we go to the trading options grid here inside the Tradier Pro software, you will see that these are very expensive option contracts. And the more expensive they get, the wider the bid and ask spread become. And liquidity, well, it's not an issue. You can easily get in and out of the trade. Trying to find where the price is actually at is a little bit different. And, you look for price discovery. I would not want to close this trade out for, well, like in my order entry ticket here, you would flip the script. This would be done for a net credit to the account. So let's do that. We're going to say sell to open because we don't have the position on in the test account. And we're going to be buying to close and then selling to open, right? And it's showing that it's a net credit, and the midpoint is a credit of $4.40, $4.30. All right, it's just all over the place there. $4.50. Now, what I would do if I'm not going to write it to expiration, I would make this be $4.90, and you could get filled today. You have 2 full days. The market could come roaring back. And I mean, we're still showing weakness. The VIX is definitely not okay with what's going on with the markets. The VIX right now is at 26.58. It's down 34 cents on the day, and we're in a down day, which is kind of crazy that it's actually down. But with that mentioned, this is the way I would enter this order, and I would just let it ride for the day. Now, if you ride all the way to expiration, you have cash settled options. So literally that $5, that $500 per 1x2x1 butterfly will show up in your account as long as the market is below 56.15. Now, if you let it ride and the market does come back, and I'm going to go back to the what if calculator, the profit and loss is a little bit screwed up in that it's basing it off of that price right there. Zoom in a little bit. If the market were to come roaring back and actually land close to here, we'd be okay with that. So I don't mind the risk of this trade right now. Our biggest risk would be is if it happened tomorrow. If we had the market go from $5,554 all and come roaring back to $5,615, and it did that in a day, we would be nervous. I think it's hard pressed to do that. So I would either close this for $4.90. I'm only willing to give up a dime out of the $5, or I'm going to wait and let it ride. And if we woke up tomorrow and the market was somewhere in here, I'd be nervous, right? Because your risk is it goes through your short strike and continues on up. All right, getting a little bit long-winded on a trade that was a winner, and we had 2 winners back to back actually in our long put our open wing put butterfly spreads, which is a mouthful. Open wing put butterfly spread. We did a couple of those in a row to get bearish, and I still like that trade. I don't mind doing the trade because we also have an alternative hedge for it. As a matter of fact, we could put one on today. Now, I do think that the markets are finally getting to the point of capitulation. The VIX isn't, the VIX is way elevated and staying well elevated. Eventually, it wants to revert to the mean, and at some point in time, we're going to get a dead cat bounce in the marketplace. So and I think it will be fairly strong when it comes back. Now, what happens after that? Who knows? I mean, it's still going. We still need to get some certainty from Washington as to what's actually going on with tariffs and everything else. Obviously, everybody knows the news and what's happening. So until we get some of that uncertainty out of the marketplace, we're still going to have extremely volatile markets just going forward. But I don't mind doing another one of these just in the short term, mainly because vols are high. We can get it done for a decent price because of where the VIX is at. So we'll look at one of those. If you have any questions, please do put them in the chat box, and I'll be happy to address them. But right now, let's look at a Bubba long call vertical. So I was looking hard to try to find something that looks interesting. And one of the things that is happening, even though there's issues, tariff wars going on, trade wars going on, however you want to call it, geopolitical concerns, the Chinese government is actually kind of trying to open their economy a little bit. They've been struggling, so they've loosened restrictions. And Bubba has taken advantage of that, which is basically, I mean, a loose interpretation would be the Chinese Amazon. And if you look at the chart is what drew me to Alibaba and symbol BABA. And you see this long bottoming pattern that has happened ever since it's broke down from this level right over here. And I think the biggest breakout to start, if I look at this, I don't know why that happened, is right in this level was a strong breakout. And now we're just in the choppiness right here. But look at this. This is basically going all the way back to 2022. This is a bottoming pattern that has happened in this underlying stock. So it's been bullish. This is a strong move to the upside. Right here, it's trying to decide where it wants to go to next. And I do think that the path of least resistance is going to be to the upside. And it's hard to find something in this marketplace that you are willing to get bullish on. So I'm going to do very simply I wouldn't mind buying a call, but the markets are just too volatile. So I'm going to look at doing a long call spread in Bubba. And here's the trade that I have set up. I already sent to the what if calculator. And let's send this to the trade ticket. But here's where we're at. Here's where our paper trade would be in this position. Market's already moved up. All right. It always seems to happen to me whenever I'm on the call, but that's fine. We're going to go a little bit in the money, and we're going to buy the 130 strike call. And we're going to give some time for this trade to run. So we're going to go to the April 17th expiration. So we need some time for this to play out a little bit. And we're going to buy a just in the money call option, the 130 strike, and sell the 160 strike. And if we run over to the trading page, let's pull up Bubba. April 17th, 36 days away. So here's where our trade is at. We got 30 points total on this trade. We're about $5 in the money. So I'm paying attention to the intrinsic value of this option contract. We're paying $5.73 in intrinsic value. We're selling about a 1 standard deviation move away at the 160 level, and we're bringing in close to $2. Well, actually, it says $2 right here if we can fill at the midpoint. So we're paying about $3.72 worth of time premium. And so our break-even point will be up above, what is it? It's going to be about 140 if we pay, oh, perfect, right at $10. If we pay $10 for this trade. And we have plenty of time to do this. Now, on this trade, it's not going to be in a trade that I want to adjust. It's not the way that I would approach this trade. If I paid $10 for it, if I got down 5, I would get out of the trade. So I'd manage my risk on the downside. And if I got cut in half on the trade, I would look to get out. If the market did run up towards the 160 level, and let's say we went 10 points to the upside, let's say we went from 136 to 146, I don't mind selling this option contract and taking some money off the table and then rolling to a more at the money option contract. You're still dealing with this about the same amount of time premium, and you can sometimes do that trade and then have the trade paid for. So you're basically playing with the house's money, and you have a long call spread on for a net cost of 0. So by selling something way out of the money, that gives you that opportunity to roll your long option contract up. Now, some people don't want to do that because it is costly to roll. You do have fees involved. You do have bid-ask spreads that you have to deal with. But it is one adjustment that I would make to a trade where I'm going so wide on a bid-ask spread, looking for a lot of bullishness in this trade. Ideally, I wouldn't mind just buying a deep into money option contract, but man, you got to go way deep into money. You got to pay a lot of money for it because implied vols are just high in the marketplace, but they're up around the 50 level in this underlying stock. So to go down to where you have a little bit of intrinsic value, get down to $1, you got to go down to the 100 strike, and now you're talking about a $3,700 option contract just to buy one of them. So that's an issue. That's an alternative. The delta there is 96, 95. You could maybe even come down to this level of 110. I don't mind that trade, but we're giving this stock a lot of room to run. We're just going to go a little bit in the money. We're going to manage our risk with this trade. If we're down to $5 on the trade, we're going to get out, and this will be the official paper trade. We're looking at Alibaba, symbol BABA. We're going to go to the April 17th expiration, which is 36 days away, and we're going to buy the 130 strike call, and at the same time, we're going to go to that same expiration and sell the 160 strike call. We're going to do this for a net debit of $10 to the account. That means we'll have $1,000 of risk on this trade. We have a stop point if the market goes down, and we lose half of that, trading for about $5 on the trade. On the upside, we may roll, but we want to give it room to run, and we got plenty of time for that room to run. And we would roll up if we got a strong move to the upside, maybe 10 points in the short term. The chart looks good. This is a precipice point for BABA right now. If we do establish a higher high here in the short term, I do think that the stock has room to run to the upside. It's been a long bottoming pattern. Things are loosening up in the Chinese government. They're trying to get their economy up and running, and BABA would be a big part of that economy if they could do it. All right. No, I don't see any other comments. And I'll throw in one last trade here. Like I said, 25 minutes. We got 5 minutes. Let's look at that SPX. I'm still okay. I'm okay with being bearish heading into the week. News headlines can affect this instantly, but we have a couple of days to trade, and vol premium is so high. So let's go and let's use the same strategy. I do enjoy that open wing butterfly in the SPX. 55.64. So let's go to 55. We need to get at. We got to get a different expiration. That is not going to work. That's going to be really expensive. Okay, so March 14th is the Friday expiration. And we do still have a position on. So if you were in your regular account, you would have two positions on in the SPX, just FYI. 55.55. Well, that's fun. Yeah, let's do that. Okay, we'll buy the 55.55. We'll go down 20 points to the 55.35, and we'll sell two of those. And then we'll go down 15 points, which would be 55.20, and we'll buy one of those. That's very good for 2 days. And that's because the VIX is at 26. So we paid $260 for our trade on Monday, and basically the exact same setup. We have 2 days worth of time decay that has happened. You only have 2 days left in the trade, and we can now come in and pay. Now it says $3. When we first came in, it was $275. I think I'm going to put this in at $280. I think you could fill at $280. That would be my goal. All right, so we're going to leave it right there at $280. So, and I'm going to let me send this to the what if calculator, and we'll leave with this note. Let's pull it down, and now you see what I was talking about as far as that open wing is concerned. Zoom in a little bit. If we blow through our low strike, this would trade for $5. If we pay $280 for it, that would leave $2.20 remaining. And here it's saying $240, so it's pricing it at $260. It's all over the place, but when it came into the calculator, it decided the price of the trade was $260. But basically, it's saying it's worth $5 less the net debit that you paid for it, and that would be $2.40. So if the market did tank like it did when we put on the first one, you would expect to make at least $2.40 on this trade. Now, on the upside, you can lose the $2.80. That's obviously a possibility on the upside, and that's going to be a risk. We can adjust the trade, but the markets are going to be moving fast. So keep that in mind, that if we do get a 1% move to the upside, we'll probably make an adjustment to this trade. But the markets will be scary. The adjustment would be scary, honestly, because we got to add additional risk to the adjustment. And if you want to see what the adjustment is, go back to the original open wing butterfly show that we set up the trade on Monday. And we talked a lot about the adjustment of the trade at that point in time. And I look over and I see we don't have any comments. And I guess that's going to be it for this edition of Options Guy TV. We'll be back this Friday. It'll be an interesting couple of days in the market and see where we're at with our Bubba trade, which is a tough market to get bullish on, but that chart does definitely look interesting. And then also we'll look at our open wing butterfly in the SPX. Thanks for stopping in, and we'll see you this Friday, 11 a.m. for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.